I'm here today to talk about the investment implications of the global macro outlook and the challenges that we all face. But I'm very aware that received wisdom is that if you get two economists in a room together, at a minimum you will have three outlooks. I'm also very aware, having listened to David, what a highly esteemed and prestigious economist he is. Fortunately, I am not. So as such, I'm not going to disagree with anything he said. I'm very much in agreement with the views that he outlines. In terms of the macro outlook, I very much agree with the cyclical tailwinds that he described, the reasons why risk assets are perhaps performing better than people have expected. Though I would caution that the structural headwinds are just that, headwinds, and the primary one is the ongoing deleveraging in the developed world. That has implications for the developed world and the developing world, which David just described. Slower growth in the developed world, higher growth and inflation driven by the developing world. I know it's not an Economics 101 term, but my view and our view is that ongoing we will have a muddle-through outcome, but that will lead over the next 3 to 5 years to ongoing higher volatility in asset markets. And that has implications for asset allocation. As David also said, I very much agree with him that rates will stay lower for longer than people have expected. That doesn't mean we don't get rate hikes, but the mean level of rates will be lower. We have to remember, though, that much of that is priced in. Look at the term structure in the bond markets. That's very much priced in. But we are at the end of a 30-year period of disinflation and falling interest rates, really triggered back at the end of the 70s, early 80s, with Paul Volcker at the Fed. And we need, in our thinking, structurally, to consider this regime shift. More cyclically, I believe that the global rebalancing that people talk about is a key going forward. And by that, I don't mean the expectation of balance moving from the west to the east or from the developed to the developing. To a certain extent, I believe in that over longer-term time frames. But if you look at the chart on the right, which shows consumption as a percentage of GDP, first of all in the US, then Germany and Japan, you can see that recently that is actually rising, whereas in China, consumption as a percentage of GDP is falling. Now, this is a ratio, so that's more about the denominator rather than the numerator, but it does remind us that growth in consumption in the developing world is not going to bail out the slowdown in growth in the developed world in the shorter term. Where I think global rebalancing should be focused is shown on the left-hand chart, which shows the response by the private sector to the recent crisis. And that is a significant build in private sector savings. I split it out between Asia and the OECD world. You can't really see it because of the scale of the chart. But if you can look at 97, 98, you can see how private sector savings in Asia responded to the Asian crisis. And you're seeing exactly the same exponentially in the developed world with that increase in private sector savings. As we see fiscal retrenchment in the developed world, as the public sector contracts, we need the private sector to unwind this savings balance. The problem we have now is that savings balance is typically on corporate balance sheets, and that is much less sensitive to interest rates. And this is why the recovery is taking longer than previously expected. We need to see pick up in CapEx, pick up in MA, pick up in corporate sector activity for the recovery to continue. The good news is, though, growth is continuing globally. We have seen previously many financial or banking sector crises. I list them on the right-hand side. On the left-hand side, just from a growth perspective, I take the average of growth pre-crisis and post-crisis. We're currently in T+3, the third year after the crisis, and you see there that that should be a good year for growth. And as David said, it appears as though this year is going to be. It does suggest, however, that next year, 2012, will be more challenging. From a market perspective, growth isn't the key driver in the short term. It's earnings growth, earnings momentum. And what I show in this chart is earnings momentum, which has been very high, remarkable recovery from the end of 2008, beginning of 2009, and that is why equity markets essentially have doubled in the last 2 years. Whilst we're off the peak, it's still in expansionary phase, but this bears watching. The line there is the average of the last 20-odd years. As we drop down, if that continues, that will be a challenge going forward. But why do we worry about this in terms of asset allocation? Because we know over the longer term that equities outperform bonds and bonds outperform cash. So why don't we just build portfolios that look like that? Well, first of all, let's challenge that. Is it true? What I show here, going back to 1900, periods of 20 years, the returns to equities, to cash, and to bonds. And you can see that the red line equities do typically outperform bonds and cash. The only era where they didn't was 1920 to 1940. Considering that had the Great Depression, perhaps it might surprise some that equities were only marginally behind bonds. Obviously, the current period, we haven't had the 20 years. For the first 11 years, equities somewhat challenged, but we have a period to go. This is annualized average returns. The problem that we know is, of course, each year returns are rarely average. So looking at a different period, 1950 to 1965, about 16 years, the real return, so I'm now adding an inflation adjustment to equities, was around 14%. The next 16 years, out to 1982, it was around 0%. The next 16 years was around 14, 15%. So who knows from 2000? And I first asked this question in 2000. Well, we don't know the answer, 2000 to 2015, but we're 3/4 of the way through. And if you take the real adjustment, I showed you earlier the nominal adjustment, take inflation off, and you are behind 0. It's a negative return so far. So how have investors adjusted to this environment? Serious challenges, not just over the last 2 to 3 years, but as we know, over the last 10, 12, 15 years, many pension funds are underfunded, insurance companies are behind their solvency ratios. People are challenging modern portfolio theory, the efficient market hypothesis, long-term capital market assumptions, which are cycle neutral, and we've just seen in the previous chart how cycles can last for 10 to 15 years. So people are now beginning to challenge that, beginning to open up their opportunity sets. And the biggest theme that we're seeing is people are beginning to allocate more risk to asset allocation decisions. Specifically, the strategic benchmark, strategic asset allocation, which assumes a neutral cycle and sets the overall risk profile of the portfolio. That is being questioned, and people, although they typically have had tactical adjustments to it, are now looking for more intermediate term or cycle-aware adjustments. And as part of the opening of the opportunity set, they're also adding non-traditional or alternative strategies and asset classes to portfolios. So what does this intermediate term or cycle-aware investing look like? Here is one approach that we use. Regime maps, investment clocks are used by many people, and I'm sure you're familiar with them. But typically at different parts of the cycle, which lasts longer than most investment time horizons, you see different asset classes out or underperforming. And just for simplicity, I've shown sort of 4 key assets: equities or your risk assets, credit, bonds, and real assets, commodities, real estate, and such like. And you can see that recently, just to let you know, in the last, since 2005-06, we have moved from the inflationary through the stagflationary, deflationary, and just in the last 6 months or so, we have been in the reflationary environment, and not surprisingly, equities have done well and credit has done well. It looks to us as though we might be exiting this phase, a relatively short time, and maybe moving into stagflationary as inflation rises and as we look into 2012, growth begins to slow. So there are investment implications of that Credit continues to do well, but real assets, and think of commodities, think of real estate, begin to outperform other risk assets such as equities. So to summarize, how are we seeing investors reacting? Now, I stress that these are not my recommendations, but the book of business that I run, we have investors from all around the world, Australasia, Japan, through Asia, Europe, and into the Americas, both north and south. And I deal with clients, central bank reserve managers, sovereign wealth funds, national pension schemes, institutional investors, DB, DC schemes, with the different challenges they have, insurance companies, as well as private wealth managers and the wholesale and retail world. And I am seeing some very consistent trends globally and across the spectrum. The first is people are moving away from fixed asset-based benchmarks, where typically you're looking to maximize the information ratio, and moving to outcome-oriented solutions, focusing more on Sharpe ratios, Sterling ratios, Sortino ratios, and a number of ratios that I've never heard of before. Asymmetry is also very trendy. People are prepared to give up 5, 10, maybe 15% of the upside in order to reduce the downside by a greater amount, say 15, 20, 30%. We're seeing real return investing as people are focusing more on the longer term outlook for inflation. And in particular, if you take the asymmetry to an extreme, people are saying, let's forget about the beta or the market returns, and let's focus on absolute or total return investing. It made a very sharp recovery after 2008, much sharper than I thought, but we are seeing private clients, we're seeing sovereign wealth funds, and everybody in between moving towards absolute and total return. The key behind this is active asset allocation, not tactically managing your strategic benchmark, but moving intermediate term, say 1 to 3 years, changing the risk profile away from your longer term, depending where you believe you are in the investment clock or the market regime. Dynamic or de-risking investing, we're seeing very much in the corporate world, where people are focusing on their assets and liabilities, and as markets recover, they're reducing their risk assets and locking in their liabilities in longer-term bond markets. There are some people that would argue, for example, take British Airways, that it's actually a pension fund with an airline attached, and many companies want to move the pension fund risk off their balance sheet, and they're beginning to lock that in going forward. As I say, I'm not necessarily recommending this, it's simply trends that I'm seeing. And finally, we are seeing a significant move away from traditional equity and fixed income markets, traditional long-only investing, to alternative strategies, such as hedge fund type strategies, market neutral, event-driven, long-short, 130-30, but also alternative asset classes, real estate, we'll hear more about that, private equity, and hedge funds. And finally, this of course comes back to the separation between alpha and beta, or the systematic returns from markets and the skill of a manager. And if there's one thing that I can summarize the experience of the last 2 to 3 years, and it simply reminds us that the most important thing is the portfolio and portfolio construction, and putting the portfolio back together again gives you a better chance of managing your overall risks.